Thanks for coming out. This is definitely the size of audience I was anticipating for an insurance conversation. So all stereotypes are ringing true, but hopefully we can make it interesting. There's a lot of really interesting things going on in the world of insurance. So we will dig in. So the first thing, talk a little bit about myself. My name is Jonathan Ableman. I'm a founder of a company called Bestow, which is a digital life insurance company. But I actually started when I was in college, and coming out of college, I started off much more in like the corporate side of the world. I worked at Goldman Sachs, went over to Lehman Brothers. We were doing proprietary investing. And one of the things I remember learning early on was this kind of pride among financial professionals that like this is just business. This isn't personal. And so when we transact, it's like this is all professional stuff. We don't get our emotions involved in it. And that kind of is like a Wall Street source of pride. Like some people think of it like a Shark Tank. I then joined in the downturn. I joined a private equity firm called Starwood Capital. And the founder of Starwood Capital is this guy, Barry Sternlicht, who has created some amazing brands that you may know, like the Westin, the whole kind of like point system from Starwood Hotels, the Heavenly Bed. He took the St. Regis from a single hotel in New York to the global brand of St. Regis. We bought Baccarat Crystal from a holding company in France, turned it into Baccarat Hotels. And so it was this whole consumerization of traditionally B2B products that I started getting fascinated with. And so I left and I started a residential housing company with a private equity firm called the Blackstone Group. And in the downturn, we bought 50,000 homes across the country and rented them out to hundreds of thousands of families. And that was kind of my first foray at kind of the personal side of business. And that business doesn't have to be just business. It can be very personal. And then we took that public early last year, and I started Bestow with my co-founder, who's unfortunately not here, but we're based out of Dallas with offices in Austin. And what I love about the consumer side is it dramatically impacts people's lives. I assume that's why you guys have chosen to either be consumer advocates as influencers, or consumer educators, or consumer-facing companies. So excited to dig in. One way that we should think about insurance and InsureTech specifically is how it falls into FinTech. So FinTech, as you kind of look at the history of where we've come, started off in the late 90s with payments, right? eBay was using PayPal, and that was like this revolutionary way of moving money online. And then payments turned into Square, which was kind of point of sale solutions for small merchants, turned into Venmo, where you can basically text money back and forth. And then we saw out of payments evolve into lending and investing and insurance with companies like Oscar and Lemonade and others. And then into real estate. And then, of course, over kind of second half of last year, crypto. And what happens is as capital flows in to this field, a lot of people who started off as financial bloggers and talking about personal finance may have started with kind of the unbundling of a bank. But it started very narrow and then has grown into several multi-billion-dollar categories. And so from that, we can look at InsureTech in particular. I know this isn't super clear up here, but basically this kind of represents a snapshot of the universe of where insurance has been heading. And it's really kind of evolved over the past couple of years, but already we have categories from homeowners and renters to auto insurance to personal lines of insurance, which is insuring your stuff, life insurance, health insurance. In Asia, like when you think about ordering something off of Amazon and returning it if you don't like it, that's actually an underlying insurance product. And so they have trillions of policies that are being covered under these insurance products. And so what you're seeing in the InsureTech world is, even though on this last slide, there's a handful of names that we point to that are kind of well known. Prosper for loans, Oscar for health insurance, TransferWise, and changing the way that people do it. There are hundreds, if not thousands, of startups that attempted to do some variation of the same thing. And these are some of the category winners or leaders that we think about. And so this is essentially what we have to navigate as consumers and businesses, is who do I work with? What do these people do? Does that help me or does that hurt me? And so that's what we're going to dig into today. We're going to dig into 5 trends that I see as materially shaping how people interact with insurance. And insurance is one of those sleepy things that virtually everybody has in some form or fashion, right? If you drive a car, you have auto insurance. If you rent, you might have renter's insurance. If you own a home, you have title insurance, mortgage insurance, homeowner's insurance. You probably have health insurance. There's some touch to virtually everybody. And the really interesting thing is, if you think about it in the context of personal wealth, Warren Buffett always kind of says one of the reasons why he's so wealthy is because he doesn't lose capital. So he capitalizes on gains and he makes sure he doesn't lose. Insurance is a loss mitigation tool. I make sure that if something happens to my health, I don't pay $150,000 for staying for a month at the hospital. If something happens to my car, I don't have to go buy a brand new car. I have an insurance company to help. And so essentially, when used right, it's loss mitigation. So we'll dig into each of these. The first thing I want to touch on, though, is something that Jeff Bezos talked about, where he said, look, a lot of people ask me about, well, Jeff, what's going to happen 10 years from now? And he said, I think the more interesting thing to ask is what isn't going to change and what isn't going to happen 10 years from now. And specifically, he says, it's impossible to imagine a future 10 years from now where a customer comes up and says, Jeff, I love Amazon. I just wish the prices were a little higher. Or, hey, I love Amazon. I just wish you'd deliver a little more slowly. So the effort we put into those things, spinning these things up, we know the energy we put in today will still be paying off dividends from our customers 10 years from now. When you have something that you know is true, even over the long term, you can afford to put a lot of energy into it. And so the energy that is coming out of this industry is ultimately going after these same 3 core principles. How do I make something cheaper? How do I deliver it faster? And how do I make the product better? And oftentimes in insurance, it's how do I make the fit of what the product covers and doesn't cover match the consumer who doesn't need to pay for what they don't need and who does need to pay for what they do need. So we'll dig into those principles as we go through it. The first kind of theme here is disintermediation. So insurance is a classic industry where agents and kind of intermediaries have classically been the way that consumers interact and buy the product. And what happens with disintermediation is the same thing with banks, right? 20 years ago, I remember going with my dad, and we'd go to this. I grew up in Northern California. There was this bank called Great Western Bank. We'd go in on a Saturday, and he'd like process some checks and do some stuff, and we'd leave. And it was like a Saturday routine. And that's where people buy life insurance. That's where they go in to get a mortgage. Now, like everything is in some form or fashion self-serve. And it may be that the full transaction is self-serve, or it may be that the initiation of the transaction is self-serve. But with disintermediation comes democratization. Democratization is what? The definition is, it's the action of making something accessible to everyone. So that's what disintermediation does, is the products broaden to just about anybody. But the problem with that is now, I mean, look at the booths around here. There are a gajillion products. How do I differentiate? So what happens is I have to figure out how to educate myself. And there's so many channels to educate. Is it a sell-side education channel where you go into the Ford dealership and Ford tells you how great Fords are and how crappy Nissans are? Or is it through an intermediary like a blogger or somebody who might be fee-only or who only blogs about what they like, and you're kind of getting their view? But take like Mr. Money Mustache. Mr. Money Mustache doesn't think life insurance has value because he thinks that it's a vote of confidence between him and his wife that you don't need to be reliant on life insurance. And I think if that works for him and they have sufficient savings and that's not a risk that they're worried about, that's great. But if I'm uneducated as a consumer and I'm just assuming that that's how I should think about life insurance, probably not a good fit for everybody. So the channel is really important, and the channels are going to expand. So you have influencers that are big on podcasts. You have influencers that are big on blogs, big on Instagram, big on Twitter, big on YouTube, big on TV, magazines and Forbes contributors. So who do I listen to? And ultimately, that's where influencers come into play. It's actually a very high quality and a high fiduciary relationship that people are monetizing. So this is ultimately how I think these channels. I was here earlier, and the founder of Trim was talking about influencers, calling them tastemakers. It's very much that of people sampling what's out there and why does it matter. And so influencers will continue to play a role. I went, just to test this out, I Googled, what's the best car insurance? And in order, there were 2 or 3 ads, which most people will ignore. And then it goes straight to NerdWallet, and then Clark Howard, Food Financial Sense, and The Simple Dollar. This wouldn't have happened 10 years ago, right? 10 years ago, it would have been Geico, Esurance, and everybody just pushing out their product. The second kind of trend is we are hitting record level amounts of funding. So you remember that earlier slide, and we talked about some of these big multi-billion-dollar startups that became large tech companies. In the insurance space, 5 years ago, there was like $217 million invested. In the last 3 years, we're projected to exceed $5 billion. What does that mean? What that means is it's more nuanced products. And so think about it. If you think about payments, the first thing was PayPal just enabling commerce, online commerce, to trade money. And then you advance to point of sale for merchants with Square. And then you advance to companies like Venmo, where I can just trade money back and forth between friends. And then you advance to companies like TransferWise, where I can now move money globally, which is completely different than Western Union, right? Who charges massive fees, and now I can just kind of text money to my family in Eastern Europe or in Mexico or whatever country. And so that will continue happening in insurance. You start off and you hear about Oscar Health, and then you hear about Clover Health, and then you hear about Bright Health, and they're all attacking different parts of the market. You think about in the life space, Policy Genius came out, and they were just kind of this quoting aggregator. And then you move into Ladder and Bestow, into Ethos, into any number of companies that are attacking the same thing. And what they're doing in order to justify more capital is they're bringing new products, they're attacking new demographics, and they're trying to serve and find niches where they can gain traction. And what that means for users is I have new value propositions coming in all the time that I have to navigate and figure out, can I actually save money? And what record level funding does is it absolutely saves money, because oftentimes investors are subsidizing the actual cost of delivering those products in order to find profitability at scale. And so when that works, you have kind of your classic innovator's dilemma, where I can ultimately find ways to make money at low margins and then scale in with a lower cost infrastructure to higher value products and deliver those at a better price. And so that's kind of what everybody's targeting. So what does that mean? That means as more money comes in, we should see prices getting lower and lower. So people thinking, well, look, I've got insurance. Why would I need to change? I've been with State Farm for 10 years. Chances are there are much cheaper policies out there than whatever your single interaction with your State Farm agent would provide. And you could find that out relatively quickly. Because now on the speed part, so much of this I can find out in seconds, if not minutes, online. And what that does is it could match me to potentially better products. And we'll talk about that here in a second. So let's talk about data. So data, I would argue, is one of the trends here that's actually a double-edged sword. So data impacts who I'm marketing to. You guys probably know this all too well. How I underwrite that risk, how I service that customer. Do I come up with cross-sells and upsells that make sense? Like, again, if I think about life insurance, I don't want to hear about some annuity product if I'm 35 years old and it's like, hey, plan for retirement, if I'm just trying to get some protection for my family. But if I have another kid, Or if I'm about to hit an age where somehow it's going to really increase my premium and somebody said, hey, if you lock it in now, you can save money for the next 20 years, I'd appreciate that. Data helps us create those interactions. But take like Root. Have you guys heard of Root Insurance before? Interesting. So Root just got valued as $1 billion company. They're out of Cincinnati, I think. It's Columbus or Cincinnati, Ohio. And sleepy little startup company. And they started with basically an app that you download. And what they do is they say, look, on that left, that graph says, traditionally, you're priced based on your driving records and how many accidents you've gotten into and what kind of cars you have. But what Root does is through their app, they look at the driver's behavior. So you download the app, and it says, go ahead and drive for the next 2 or 3 weeks. And if we accept you, you could save potentially 50% off of car insurance because we only insure good drivers. So we're not subsidizing the cost of good driver insurance with bad driver insurance. And so what they'll do is they'll take you through this process. So I thought, oh, this is great. I don't put a lot of miles on my car. I should go apply for Root. So I downloaded the app, and I was driving around. And I would say I view myself as a good driver, sometimes maybe a little faster, a little reluctant to come to a full stop at stop signs. But I thought, oh, I should be okay. And so I was driving, and you can check, and periodically it'll say like, oh, you're a B here, you're an A here, you're a C here, and you can say, okay, I got to slow down around corners, I got to do this or do that. So I'm in like week 2, I think going into week 3, and I had just sold my car. And so I was actually taking my car in to drop it off and go get my other one. And because it was the last drive, I have 2 kids, 2 boys, and my 5-year-old who's obsessed with cars, he's like, Dad, you got to go really fast just because this is the last time we're going to have this fast car, and you got to show me how fast it goes. And it was like a Saturday morning, not a lot of traffic. And so on this on-ramp, I floored it. And I didn't go that fast, but apparently Root measures acceleration and stopping. Because after I did a couple loops, on-ramp, off-ramp, and doing this or that, guess who got kicked out like the next day and said, oh, you failed. We can't offer you insurance. So it's really interesting because I read reviews. So they've gone from, like $5 million in premium earlier this year to a run rate of $60 million. They have, I assume, somewhere between 50 and 100,000 customers, and they're in like 12 states. And they're rolling out state by state. And with the reviews, if you go to the App Store and you read the reviews, people are saving massive amounts of money that safely go about their driving and don't get in accidents. This works if you're a good risk. If you're apparently, like me, in a bad risk, even though I haven't really gotten into any accidents, but according to their algorithms, I am not somebody they want to insure because I'll randomly take my 5-year-old on quick accelerating car rides. And so this is a double-edged sword because this applies not just to auto insurance, but it applies to life insurance, health insurance, insuring your valuables, all sorts of things. And as you guys know, data isn't always perfect. How many of you know somebody who got something on their credit score that either wasn't them or was some random bill from college and nobody even told me about that and the doctor's office screwed it up? Like, what are you talking about? And we're relying on those FICO scores to make a lot of credit decisions. So data isn't always perfect. But what it does do is for the masses, it dramatically can reduce the cost of low risk, accelerate products to people, and ultimately create a better experience as tens of thousands and soon to be hundreds of thousands of people are doing with just one auto insurance company. Does that make sense? So good and bad there. Another thing that's going on is with technology coming into an industry that hasn't seen technology ever in a long time, is it creates scale. So take Lemonade. Lemonade came out and said, we're going to be a socially responsible insurance company. We're going to take a flat fee to manage the business, and anything left over that isn't claimed goes to charities. And a lot of millennials say, that's awesome, sign me up. And in fact, over 250,000 people in the last 2 years have signed up paying insurance to Lemonade. And so I don't know of carriers who, at the speed of human capital, can accelerate trajectory like you can at the speed of the internet. And that is really interesting. When apps go viral, when these reviews start coming out, there's meaningful impact. But the other thing it does, which is kind of hard to see on this screen, I apologize, but what this shows is Lemonade is able to support 2,500 customers per employee because they have automated. Geico at the bottom is 143 policyholders per employee. What does that mean? Well, what goes into your premium? Your premium is a mix. I assume it's similar across insurance, but take life insurance, for example, because that's what I know best. It's your target return on capital, your cost of marketing and any commissions. It's your cost to underwrite the customer. It's your administrative load that you put on it. And all of these things go into ultimately what the consumer has to pay, because you have to stay profitable as an insurer so you can make payout claims and continue to exist. And therefore, if I can reduce any of those cost verticals, I can pass on those savings to the consumer, or I can make more money. And one great thing about startups is they're willing to break even, if at all possible, to make money in the long run. Everybody wants to be Jeff Bezos. And so what you'll find is you should see many companies that are offering dramatically reduced cost policies, which can save people a lot of money when navigated well and when they're the right audience. Yeah. Yeah, so the question is, so many times people have taken rebates and given it back to the customer. Does it matter if it goes to a charity? I think at the end of the day, we're going to see both. Now, I know on the rebating side, there's issues because there's a lot of anti-rebating rules and regulations, and it depends on which country you're in, which state you're in, even within the U.S., as to what an agent can do, what a direct to consumer carrier can do. But I think ultimately you're just going to see both. You're going to see, as the category expands and you see more and more logos up here, you're going to see some companies that drive a large audience because people say, that gets money back in my pocket. That's worked really well for the banking model, right? Like a lot of people who started banks, and you can get higher dividends and rewards, or acorns, there's found money and blah, blah, blah. On insurance, you're going to see the same thing. There's those who are socially minded, and they're like, I would rather see, it's not consequential anyways, it's 5%, it's whatever. Let's go give that to a charity. I feel better about what I'm doing. I feel better about my transactions. And others that say, I feel much better when that goes back into my pocket. And so, Lemonade specifically, I would say they're more millennial focused. Well, their target is kind of, call it under 40. And their goal actually was to go out and acquire and turn non-insurance customers into insurance customers, and then start to grow with them as those guys earn more money. So here's another trend. Integrated offerings. Ultimately, you're just going to see bundling. So Hippo, they're a homeowners insurance company. They're going to partner with Comcast, and they're going to deliver when Comcast has their new mailer and you just moved and we're going to blast you with all this stuff, homeowners insurance. Jetty, renters insurance, they partnered up with Blackstone, who owns hundreds of thousands of units, and now all of those landlords offer an integrated renters insurance, which also gives you, if you don't have the money for a deposit and all that, Jetty can help you with that. With life insurance, which is something that is life event driven, nobody puts a gun to your head and says you have to buy. People typically buy around life events. So what you can do is you can bundle into other products and services that hit people when they have a kid and they go, oh yeah, life insurance makes sense. It may not make sense on Facebook when I'm just trying to check my messages. It surely would make sense while I'm applying for a mortgage and I'm thinking about my finances. And so this is where the relevance to where somebody's actually going to pay attention and start to transact lowers customer acquisition costs, which long-term lowers the cost of premiums and saves people money. So the 5 things you need to know, ultimately, what does this mean? This means that, in my opinion, things are getting cheaper, they're getting faster, and they're getting better. Right? Even if you stayed at the status quo, those people are still going to get served. Even if I was kicked out of Root for car insurance. Well, I didn't have Root before. So I guess I can't save money with Root, but I'm not like paying more because State Farm found out that I didn't pass the Root test and now they're going to raise my premium. I'm just going to still use State Farm. Or if I don't want renter's insurance, I don't have to buy Lemonade. But if my landlord mandates it and I can shop Lemonade and they're $5 and Assurant is $10, well, then I have the option to pick one versus the other. And so that's really what it's about, is it's about consumers having options and how they find out about those options, which is ultimately, as we get to democratization and disintermediation, influencers become really critical. It's how people act, how they need to think about it, and how they ultimately find their cheaper, faster, better products.